Every few weeks you'll hear it in the news that the Fed has raised rates, or that the Bank of England has cut rates, or if you're in New Zealand, that the OCR is being raised or lowered. Here's the thing, that one number, whether it's called the OCR or the Federal Reserve rate or the base rate, that has an effect on almost every single part of your financial life, from your mortgage to your savings, and even to the price of your morning coffee. So stick around, because by the end of this video, you'll not only be an expert on the central rate, but you'll know exactly how it affects you, and especially how it affects your wallet. So these rates have different names. I've said a few already. There's the OCR, there's the Fed funds rate, there's the base rate. They're all versions of the same thing. They're the short-term interest rate that is charged by a central bank. Now, a central bank is the bank for a bank. So a lot of us have our own personal bank where we deposit and withdraw money. A central bank does that for your bank. So there's a few names you might have heard already for a central bank. So in the United States, it's the Federal Reserve. In the UK, it's the Bank of England. In Europe, it's the European Central Bank. Australia, the Reserve Bank of Australia, and so forth. Their job isn't to sell you mortgages or to open a savings account with. Their job is to ensure that the financial system of that country, the economic system, is stable and secure. But why do banks need to borrow money at all? Well, banks don't sit on giant piles of money. In fact, a lot of the money that they have is lent out. So they're lending money out for mortgages, they're lending money out for credit cards, for business loans. And at the end of the day, the bank needs to make sure that their accounts balance. So everything that's coming in versus everything that's going out. If they're short on money, they need to go and borrow from a bank or the central bank to make that right, to make that sum equal. Think of it like running out of milk. So your fridge might be full of food, but if you need to kind of get through to the morning, if you need some milk for your cereal in the morning, you might go to your neighbor to borrow some milk for the evening. And the rate that central banks charge to borrow that money, that is the rate that you're hearing about on the news. And that is the rate that sets the tone for almost every single interest rate in that economy. Okay, so let's talk about how this affects you specifically. So the major way you'll see it is with mortgages and loans. When a central bank raises rates, it becomes more expensive for banks to borrow. They pass that cost straight on to you and to me, the consumers, us. All of us. So your mortgage rate goes up, your car loan gets pricier, and your credit card interest climbs. But what happens to all of that money that central banks are paid to by regular banks? It doesn't vanish into some secret vault. No, it goes into their vault, but it's used to maintain the functions that a central bank provides. So like I said before, it doesn't do mortgages or give you a savings account. What it does do is it provides payment infrastructure. So it manages the way that people send and receive money between each other. It has oversight over financial and economic aspects of a country. And it's responsible for printing new currency. So new bills, new money is printed by a central bank. And so the money that goes into these central banks is used to pay to help those services to happen. So salaries for people to work there, infrastructure, etc., etc. Now, most central banks aren't meant to be profit driven. It's kind of like paying a toll on a motorway. So the goal is that the toll booth isn't enriching itself, but that the traffic on that road is flowing smoothly. And that's the goal of a central bank. The other way you'll see it is with savings. So when rates rise, it's generally savers, people who save money, who have money in savings accounts, who benefit, because your savings account or your term deposit will earn more money. In a low rate world, it's the borrowers who are the winners because they can afford to borrow money at a cheaper rate. Businesses borrow as well, whether that's a cafe that's borrowing money to buy a new coffee machine, or it's a farmer borrowing money to buy a new tractor. When their borrowing costs go up, so do the prices of the goods and the services that they provide to you. Central banks change this rate for one real reason, and that is to control inflation. Now we'll just sidestep a little bit and talk about inflation because it's really important to understand why changing this rate is so meaningful. So imagine the milk that you needed, that you ran out of, is $3 last year. This year, it's $3.20. Now, you might not think that that 20 cents is much. In fact, in isolation by itself, it's not. But if you scale that up across an entire economy, everything, rent, food, petrol, clothing, if it all creeps up like that, 20 cents, 10 cents, 5 cents at a time, your money, the dollar that's in your pocket, starts to buy less. That's what inflation looks like. On the flip side, if inflation is too low or if prices start falling, people's spending decreases because they can anticipate that they might get a service or a good cheaper in the future, so they hold off on spending. And that's called deflation, and that can freeze an economy completely. That's why central banks like the Federal Reserve in the United States or the Reserve Bank here in New Zealand, they're constantly tweaking this rate because they need to keep inflation in this kind of Goldilocks zone. So they don't want it too hot and they don't want it too cold. They want it just right. Think of the economy like a car. So if the car's going really fast, if it's speeding, they'll tap the brakes with higher rates, right? They want to slow the car down. On the other side, if it's crawling, they'll press the accelerator down with lower rates. So most central banks will generally aim for about 2% interest rates. So that's just enough to keep things moving along without overheating. Here's the tricky part. The data or the information that these central banks are using to make the decision about whether to change or lower or raise interest rates, it's based on things like unemployment, on housing demand, on global oil prices, and those things always lag behind real life. So rate changes don't work instantly. They can take months for them to ripple out and for you to feel them in things like mortgages and rents and prices. So when you hear a rate change, you may not feel it straight away. It's kind of like steering a big ship. When we talked about driving a car, well, think about driving a ship. It's not going to turn instantly even when you turn the steering wheel. It takes a long time for that mechanism to move. Central banks are not supposed to make choices based on politics or pressure, only on economics. But in reality, money and politics are like two magnets, and they're constantly attracting themselves to each other. So in an election year, a politician or a political party might put pressure on a central bank to lower rates. I mean, would you be more likely to vote for someone if they managed to make it so your mortgage was cheaper? Maybe. And so it shows the importance of why these central institutions, something like a central bank, need to be independent, because if they're making decisions based on what a politician or a party wants, quite often they could completely freeze or completely overheat the economy, all for what is generally a short-term gain. All right, so here's a real-world example of rate changes in action. So in 2020, as COVID-19 was sweeping the world, almost every central bank in the world cut rates to near zero. And the goal of this is survival. It was to keep economies alive during lockdowns, because obviously no one can go out of their homes. It's a completely unprecedented event. So you've got cheap borrowing, it's fueling spending. People are able to spend money again. They're able to invest money again, put money into markets, that kind of thing. Here in New Zealand, we saw house prices go absolutely bananas because people were able to borrow money from banks at a lower rate, so they could afford to borrow more. But as the pandemic sort of waned out and life got seemingly back to normal, there comes the post-pandemic spike. So inflation starts soaring from Washington to Wellington, from London, Sydney. Banks are slamming on the brakes. The Fed, the Bank of England, the ECB, they're all hiking rates at record pace. And so the result of that is you're seeing mortgage payments double, triple for millions of people. Painful, absolutely, yep, but that's how they call the system. I just want to reiterate how important it is that people with less financial literacy understand what things like the official cash rate or the interest rates do, because as you can see, they affect every facet of our financial lives, and sometimes we just are swept along with it. We see the headline like, cool, yeah, that doesn't affect me, but it does. So now that you're an expert on the rate and what that means, not just for you understanding it, but knowing how to fix your wallet, I've got a bunch of other videos which explain basic financial concepts in plain English. You can check those out over here, and I'll leave a few links in the description below as well. If this video was helpful in you understanding the interest rate, I'd really appreciate a like. And if this channel is something that's helpful for you, Plain English Money Chats, then hit subscribe. Leave me a comment below as well. I'd love to hear from you what the interest rate means to you in your situation, because if I can learn this stuff, you can as well. I'm Chris, this is the Money Translator, and I'll see you in the next video.